Today, July 30th, 2025, is a critical day for the gold market. Traders and investors are watching closely. The reason for this intense focus is a series of high-impact news events coming from the United States. These events are scheduled between 4:15 p.m. and 10:30 p.m. GMT. They have the power to create significant price swings in the precious metal. Gold prices often react strongly to news related to the US dollar. When the dollar's value changes, the price of gold, which is priced in dollars, usually moves in the opposite direction. This makes US economic data extremely important for anyone involved in the gold market. The afternoon begins with the ADP non-farm employment change at 4:15 p.m. GMT. This report gives an early look at the US jobs market, a key indicator of economic health. A strong jobs number suggests a robust economy which can strengthen the US dollar and put pressure on gold. Following this, at 6:00 p.m. GMT, we have the ISM Manufacturing PMI. This index measures the health of the manufacturing sector. A reading above 50 indicates expansion. Strong manufacturing data is another sign of a healthy economy, which is typically bearish for gold prices. These reports set the stage for the day's main event later in the evening. Later, at 6:00 p.m. GMT, we also get the JOLTS job openings data. This report provides insight into labor demand in the U.S. A high number of job openings can signal a tight labor market and potential wage inflation. This can influence the Federal Reserve's thinking on interest rates. All these pieces of data are important. They give a detailed picture of the U.S. economy. Traders will analyze each release carefully. They will try to predict how the Federal Reserve will interpret this information during its policy announcement, which is the most anticipated event of the day. The grand finale of this news-packed day is the Federal Open Market Committee statement and federal funds rate announcement at 9:00 p.m. GMT. This is followed by the FOMC press conference at 9:30 p.m. GMT. The FOMC's decision on interest rates is the most powerful driver of the US dollar and, by extension, gold. A change in interest rates or even hints about future changes can cause immediate and sharp movements in the market. The press conference is just as important, as reporters will question the Fed chair about the economic outlook and future policy direction. The Federal Reserve's announcements are the highlight of the day. The market's reaction will depend on whether the Fed's tone is hawkish or dovish. A hawkish stance means the Fed is concerned about inflation and might raise interest rates or keep them high. This makes the US dollar more attractive to investors. Higher interest rates increase the opportunity cost of holding gold, which does not pay any interest. As a result, a hawkish Fed is generally negative for gold prices. Investors might sell gold to buy dollar-denominated assets that offer better yields, causing gold's price to fall. On the other hand, a dovish stance from the Fed suggests it is more concerned about economic growth than inflation. In this scenario, the Fed might signal future interest rate cuts or a pause in rate hikes. This would weaken the US dollar. A weaker dollar makes gold cheaper for investors holding other currencies, often boosting its demand and price. Lower interest rates also reduce the opportunity cost of holding gold, making the non-yielding metal more appealing as a safe haven asset. Therefore, a dovish message from the Fed is typically very bullish for the price of gold. For example, if the Fed chair, during the 9:30 p.m. GMT press conference, emphasizes that inflation remains stubbornly high and that the central bank will not hesitate to act, the market will interpret this as hawkish. We could see the US dollar index spike higher. In response, gold prices might quickly drop, breaking below recent support levels. This is a classic reaction to hawkish monetary policy signals. The language used by the Fed chair is scrutinized word by word by traders looking for clues about the future path of interest rates. Conversely, imagine the Fed chair says something like, "We are seeing encouraging signs of cooling in the economy, and that the committee is now monitoring downside risks to growth." This would be a clear, dovish signal. Traders would likely sell the US dollar and buy gold. This could trigger a strong rally in the precious metal, pushing it toward key resistance levels. It is this uncertainty and the potential for a major policy shift that creates so much volatility. Gold traders must be prepared for either outcome and understand the direct link between the Fed's language and gold's price action. Beyond the fundamental news, traders are also watching key technical levels on the gold chart. These levels act as important psychological and structural points. They can often determine the direction of the next major move. Currently, two significant levels are on every gold trader's radar. The first is the high from last month, which is around the $2,415 per ounce mark. This level represents a major resistance area. A sustained break above this price would be a very bullish signal for the market, suggesting that buyers are in firm control. If the news from the FOMC is particularly dovish, it could provide the catalyst needed for gold to break through this $2,415 resistance. A dovish surprise, such as an unexpected hint at rate cuts, could send gold prices soaring. A close above this level on the daily chart could attract more buyers. This could open the door for a move towards higher targets, potentially even challenging all-time highs. Traders will be watching for strong volume on any breakout attempt. A breakout without convincing volume might be a false break, a trap for unwary buyers. On the downside, the key support level to watch is last month's low, around $2,280 per ounce. This area has provided a solid floor for prices in the recent past. A break below this level would be a significant bearish development. It would signal that sellers have overwhelmed buyers and that a deeper correction is likely underway. A hawkish surprise from the Federal Reserve is the most likely trigger for such a breakdown. A stronger than expected jobs report followed by a hawkish Fed statement could easily send gold tumbling toward this support. Should gold prices convincingly break below the $2,280 support level, the next logical targets for sellers would be lower. This could initiate a new downtrend. Such a move would confirm that the market sentiment has shifted from bullish to bearish. The area between 2,415 and 2,280 is essentially a major battleground. The outcome of today's news will likely decide whether the bulls or the bears win this fight. Traders should monitor these levels closely in the aftermath of the FOMC announcement to gauge the market's true direction. Trading during high-impact news events like the FOMC announcement is not for the faint of heart. The market can become extremely volatile and unpredictable in the minutes immediately following the release. Prices can move dozens of dollars in mere seconds, often in both directions. This is known as whipsaw action. Trying to guess the direction and place a trade right at the moment of the announcement is a form of gambling, not trading. It is very easy to get stopped out for a loss due to the wide price swings, even if your long-term directional bias is correct. The most prudent advice for most traders is to wait. It is often wiser to let the initial chaos subside. Wait for the market to digest the news and establish a clear direction. This might mean waiting 15 to 30 minutes after the 9 o'clock p.m. GMT announcement and the subsequent press conference. Let the smart money make its move, and then look for opportunities to join the emerging trend. A confirmed breakout above a key resistance level or a breakdown below a key support level after the news provides a much higher probability trade entry than simply guessing beforehand. Here are a few simple tips for navigating today. First, know the key price levels in advance, such as the $2,415 resistance and $2,280 support. Second, have a plan for both a hawkish and a dovish outcome. Decide what you will do if the price breaks up or breaks down. Third, if you do trade, consider using smaller position sizes than you normally would. This will help you manage risk during a period of heightened volatility. Finally, avoid chasing the price. If you miss the initial move, wait for a pullback or a consolidation before considering an entry. In summary, today is a day for patience and strategy. The U.S. economic data and the FOMC announcements will undoubtedly create significant trading opportunities in the gold market. However, these opportunities come with increased risk. By understanding the potential impact of the news, identifying key technical levels and waiting for a clear market direction to emerge, traders can position themselves to navigate the volatility safely. Rushing into a trade blindly on a day like today is a recipe for disaster. Wait for confirmation.